In FY21, passive mutual funds saw a huge investment of around 1.5 lakh crore rupees across categories like large cap, mid cap, international as well as sectoral segment. Passive mutual fund investment that once struggled to catch the attention of retail investors have now started to gain popularity, and looks like in the near term, passive funds are all set to go big. Hello friends, my name is Sahil and this is my Personal Finance Academy. Passive mutual funds in India are growing at a crazy rate. According to research, passive mutual fund AUM in India during FY16 was around 22,000 crore rupees. But over the next 5 years, passive mutual fund AUM has grown to levels of 3.1 lakh crore rupees by FY21 at a crazy CAGR of 69%. And it is expected that passive mutual fund AUM in India would touch rupees 25 lakh crore by FY25 at another 69% CAGR. These are crazy numbers. Passive mutual fund AUM as percentage of total mutual fund AUM was around 2% in FY16 and that jumped to 10% in FY21. And it is expected that passive mutual fund AUM will become 37% of total mutual fund AUM by FY25. So in this video, we will try to understand the reason behind the rising popularity of passive mutual fund. Then we will also discuss how you can build a passive mutual fund portfolio. And then we will discuss how do you select the right passive fund. But before that, we'll quickly look at the difference between active versus passive mutual fund. Alright, let's get started. In simple language, active mutual funds are the funds which are actively managed by the fund house, where the fund manager actively buys and sells the stock to generate higher return. The ultimate goal of each mutual fund manager is to beat the benchmark. Now, what is a benchmark? So benchmark is the criteria you can use to compare the performance of a mutual fund. For example, let's say in last 1 year, your mutual fund generated around 12% return. Now, what can you infer out of it? Did it perform well or not? For that, you need to compare it with the benchmark. If the benchmark has given 15% return in last 1 year, then your mutual fund has not done well. But let's say your mutual fund has given 5% return in a year, but benchmark has given 3% return. In that case, the mutual fund has done well as it is able to beat the benchmark. So every active mutual fund manager has one goal: to beat the benchmark and to generate that alpha, that is additional return. For example, Sensex is a benchmark for those mutual funds that invest in top 30 companies of India. Nifty 50 is a benchmark for those mutual funds that invest in top 50 companies in India. And in order to generate higher return, active mutual fund house charges a fee, that is expense ratio, in the range of 0.5% to 1.5% to actively invest your money in the stock market, where the fund manager would keep on buying and selling the stocks frequently. Here we are talking about direct option. Regular option would have additional commission from the agent. So that would result in even higher expense ratio. But what if the active mutual fund is not able to beat the benchmark? In that case, isn't it better to invest directly in the benchmark? Why pay a high expense ratio? That's where your passive mutual funds comes into picture. Passive mutual funds exactly replicates the benchmark. For example, if there's a passive mutual fund that replicates Nifty 50, then passive mutual fund would hold each stock of Nifty 50 in the exact same proportion. For example, let's say if a company A has got a weightage of 12% in Nifty, then out of rupees 100, 12% of your money would be invested in company A. If company B has 7% weightage, then 7% of the money would be invested in company B, and likewise. Now, passive investment style is gaining popularity in India. In fact, there are a lot of new age companies that are focusing on passive investment. For example, Navi Mutual Fund, which is backed by Sachin Bansal, is currently focusing on passive style of investing, and within index fund, it has lowest expense ratio in the category, with expense ratio as low as 0.06%. They have multiple index fund offerings across India and international category. So you can also diversify your portfolio by investing in international fund with Navi Mutual Fund that gives you access to invest in top US companies like your Google, Apple, etc. at low cost expense ratio of 0.06%. Within 1 year since they launched passive fund, their AUM has grown to over rupees 500 crore. If you want to explore Navi Mutual Fund, I provided the link in the description. Now let us try to understand why passive funds are getting popular. So there are 3 important reasons why passive funds are getting popular. Number 1 reason is majority of active mutual funds are unable to beat the benchmark. In one of the latest research report, it was mentioned that 50% of large cap funds failed to beat S&P BSE 100 benchmark in 2021, and 82% active mutual funds failed to beat the benchmark over 5-year period. It basically means that there are high chances that the active mutual funds you have invested in have not been able to beat the benchmark. In fact, not only in large cap segment, this is the same story in mid cap and small cap segment. Around 56% active mid cap and small cap mutual funds were not able to beat the S&P BSE 400 mid and small cap index over a period of last 5 years. So majority of active funds that charges a high fee to generate that higher return than benchmark are actually not even able to beat the benchmark. Personally, I have come across many cases where investors invested in active mutual fund based on past return. So majority of investors end up selecting mutual fund simply based on past return. They will sort the mutual fund from higher to lower return in last 1 to 3 years and invest in mutual fund that generated the highest return. The biggest problem with this approach is that there is no guarantee that the active mutual fund that was among the top performing fund in the past would continue to outperform in the future. So basically, after some time, investors realize that their mutual fund is not performing well and they want to change the fund. Ultimately, these investors end up generating lower return than benchmark. Hence, now investors have realized that it makes sense to directly invest in index fund that replicate the benchmark, so that at least there are high chances that you get returns similar to benchmark. Now, second reason is low expense ratio. Expense ratio is one of the biggest reasons why passive funds are getting popular in India. Passive funds charge a very low expense ratio of as low as in the range of 0.05% to 0.3%, whereas active mutual fund expense ratio is typically in the range of 0.5% to 1.5%. For example, if an active mutual fund has generated 12% return and it has 1.5% expense ratio, then you will get only 10.5% return. And in the long term, the high expense ratio of active mutual fund put a big dent in the final returns. Also, this high expense ratio is the major reason why majority of active funds struggle to beat the benchmark. And this expense ratio is not fixed. Companies can change this expense ratio time to time. So investors have now realized that it is better to have higher exposure in passive mutual funds that charges a very low expense ratio. Then third reason is no-brainer investment. The best part with passive mutual fund is that even a person without much knowledge about investment can also invest in passive mutual fund. As we discussed earlier, in case of active mutual fund, investors opt for mutual fund that have generated highest return in the past. But the biggest challenge is that you never know whether the same mutual fund you have invested in will continue to generate good return in the future or not. In fact, it can also happen that the mutual fund you have invested in underperform and not even able to beat the benchmark. But passive mutual funds replicates the benchmark, and hence the return will also replicate the benchmark subject to tracking error. Now that we have discussed why passive mutual funds are getting popular, the next question is how to build a passive mutual fund portfolio. So first of all, there are two types of passive fund, passive ETF and index fund. Essentially, both passive ETF and index funds are similar where they simply replicates the index. The only difference is that index funds can be bought and sold like mutual fund, whereas passive ETFs can be bought and sold like stocks. So in case of index fund, you don't need a trading and demat account. You can directly invest in index funds just like mutual fund. But with passive ETF, you would need a trading and demat account where you can buy and sell passive ETFs just like stocks. Again, if you look at the risk versus return, both passive ETFs and index funds have similar risk versus return profile. And even the cost structure of both are similar. So it is totally up to you whether you want to invest in passive funds via index fund or passive ETF. The only catch is that with a passive ETF, you need to make sure that it has enough liquidity in the market so that when you want to buy the ETF, you should find the seller, and more importantly, when you want to sell, you should find the buyer. As far as categories within passive mutual funds are concerned, there are many categories of passive fund. The most popular category is Nifty 50 based passive funds, where the fund simply replicates the top 50 stocks of Nifty in the same proportion as per their weightage. Then you also have Nifty Next 50 Index that help you invest in stocks ranking from 51 to 100. Then you have Nifty 100 category, then Nifty Midcap 150, where you can invest in 150 midcap stocks of India. In fact, there are also passive funds that let you invest in US market. For example, Nasdaq 100 Index Fund help you invest in top 100 companies of US. Then there are sectoral passive funds that replicates a specific sector. For example, Nifty Bank-based passive funds would invest in all the banks within Nifty Bank Index. And these options are available across index fund and ETFs. So as an investor, one can build a diversified portfolio with a major allocation in Nifty 50 based index fund and can also diversify by investing a portion in US based index fund. As we discussed earlier, since passive mutual funds simply replicate the index, there won't be a huge difference in returns. Most of the passive funds replicating the same index would generate returns similar to benchmark. However, there are a couple of parameters that can make a difference. First is obviously the expense ratio. So index funds with lower expense ratio would have a higher probability of generating similar returns to benchmark. And second parameter is tracking error. Tracking error is basically the difference between the index fund return and the returns of the index which the index fund is replicating. Think about this. If an index fund is replicating Nifty 50, then ideally index fund return should be exactly same as Nifty 50 return, isn't it? But in reality, there would be some difference and Nifty 50 index fund return would be slightly lower than Nifty 50. And this is applicable for all the index fund. The key reason for this difference is because of 2-3 factors. Now, first factor is due to the expense ratio the index fund charges. This expense ratio is the fee of the fund house to manage the fund. This reduces the overall return. Then second reason is because index fund may see an inflow of cash due to a sudden increase in investment or payout of dividends by stock in its portfolio. In such cases, the fund manager may take some time to reinvest this money and this can contribute to an increase in tracking error. Moreover, there can be redemption requests from investors. So fund houses keep somewhere around 2 to 5% of investable assets aside in cash or highly liquid debt instrument to take care of redemptions. That again contributes to increase in tracking error. So if you want to invest in an index fund, you need to ensure that the index fund has a lower expense ratio and lower tracking error. So in this video, we discussed why passive funds are getting popular in India. The biggest reason is underperformance of majority of active mutual funds and low expense ratio of passive funds. Moreover, you don't need to actively track the passive funds, so that gives a peace of mind. Then we discussed the various types of passive funds and difference between index fund and passive ETF. And finally, we discussed how you can select the right passive fund. If you want to explore Navi Mutual Funds, I have provided the link in the description. I hope you will find this video useful. I'll see you next video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully. म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।